1973. Gold rose 40% in 60 days after OPEC extended its oil embargo past the December deadline. 1990. Gold ran from $376 to $417 in the 8 weeks between Iraq's invasion of Kuwait and the United Nations January deadline. 2022. Gold climbed from $1,800 to $2,070 in the 45 days between Russia's invasion of Ukraine and the first ceasefire negotiation collapse. Every single one of those moves was preceded by the exact same 5-step sequence. And 4 days from now, on April 28th, the Iran ceasefire expires. Oil is already pricing in the collapse of talks. The DXY peaked at 106 3 weeks ago and has started retreating. Gold pulled back from $5,589 in January to $4,300 in March and is now grinding higher again. Elena Marquez, 48, urgent care nurse in Phoenix, Arizona, bought her first ounces of gold in 2023 at $1,900. She has added every time the financial press called gold broken. She has not checked her brokerage app in 11 days. She knows something about what happens in the 48 hours before a ceasefire deadline that almost nobody watching CNBC understands. My name is Ban. I have been tracking this 5-step sequence for 9 months across 53 years of war extension and deadline collapse data, Federal Reserve policy records pulled from the FRED database, DXY index movements from the Intercontinental Exchange, the International Energy Agency's historical oil price tables, and the World Gold Council's quarterly gold demand trends reports going back to the end of the gold standard in 1971. I am going to show you every historical instance this sequence has run, what happened at each of its 5 steps, and what Tuesday, April 28th, has signaled every single time a war extension deadline has arrived with talks collapsing. No opinions, no geopolitical speculation, just the documented record. If you hold gold or silver right now, or if you have been thinking about positioning before Tuesday, stay with me, because before we are done, I am going to show you the 2 specific numbers that tell you Step 4 has begun, and the 3 instruments that have historically captured the most of what Step 5 produces. Like this video, subscribe to the channel, share it with someone who is watching oil headlines and does not know what phase of the sequence they are standing in. Because what happens after a war deadline collapses is not a theory. It is a pattern so consistent across the last 5 decades that it stops being coincidence and starts being mechanics. I call it the war extension sequence. 5 steps. Every major gold and oil move tied to a war deadline since the end of the gold standard has run through it in the same order. Step 1 is the deadline approach. A ceasefire, embargo, or ultimatum sets a specific date. Markets begin repricing 3 to 5 trading sessions before the deadline, as options desks and hedge funds position for binary outcomes. Brent crude implied volatility climbs. Gold options open interest expands. This is happening right now in the oil market. The April 28th contract on the United States oil futures curve is trading at premiums that the Financial Times described this week as reflecting a 40% implied probability of talks collapsing, based on the skew in energy options pricing. The International Energy Agency's March 2026 monthly oil report confirmed the same dynamic from the physical market side. Shipping rates through the Strait of Hormuz had already begun rising in anticipation of the deadline, with insurance premiums on tankers transiting the strait up 14% month over month. Step 1 is in its final hours. Step 2 is the deadline breach. The ceasefire expires without renewal. Either talks collapse publicly, or one side refuses to sign an extension, or the deadline simply passes without announcement. The market reaction is immediate and mechanical. Oil futures gap higher at the next open. Gold futures either spike with oil on the first session or lag by 1 session before catching up as the dollar move clarifies. The DXY either surges on safe haven flows or weakens if the breach raises questions about dollar system stability. In 1973, when OPEC extended the embargo past the December deadline and announced production cuts would continue into 1974, oil ran from $5.03 per barrel to over $12 within 90 days, and gold rose from $100 to $140 in the first 60 days following the announcement. In 1990, when Iraq refused to withdraw from Kuwait before the January 15th United Nations deadline, oil had already priced in most of the move by mid-January, but gold captured another 8% in the 2 weeks after the deadline passed. In 2022, when the first Russia-Ukraine ceasefire talks collapsed on March 8th, oil spiked to $130 per barrel within 72 hours, and gold broke through $2,000 for the first time since 2020. Step 2 is where binary positioning pays off or gets destroyed. Step 3 is the dollar reaction. This is the step where most retail investors get confused because it runs in one of two directions depending on the nature of the conflict. In supply disruption shocks, 1973 OPEC, 1990 Iraq-Kuwait, the dollar surges because global oil demand denominated in dollars spikes and safe haven capital flows into United States treasuries. Gold initially falls in dollar terms even while its real purchasing power rises. In credibility shocks, post-2008, the dollar has started weakening on breach events rather than strengthening because markets begin questioning whether the dollar system can absorb another major geopolitical disruption on top of its existing fiscal stress. In 2022, the DXY did both in sequence, surged from 96 to 114 over the first 6 months as initial safe haven flows dominated, then began its 3-year slide as reserve diversification accelerated and central bank gold buying reached records. In April of 2026, the DXY peaked at 106 in late March and has already begun retreating. That is the credibility shock pattern, not the safe haven pattern. The dollar is not strengthening on this crisis, it is weakening. Step 3 is telling you which mechanism is running. Step 4 is the real yield peak. Oil prices push inflation expectations higher. Higher inflation expectations force the Federal Reserve to either tighten policy or accept that inflation will run hotter than target. Either path drives real yields, the return on Treasury bonds after adjusting for inflation, to a short-term peak. The 10-year real yield climbed from 1.72% on February 27th by March 27th in anticipation of this exact deadline event. That 41 basis point move priced in most of the gold pullback from the January peak. Step 4 has been running for 6 weeks. The peak is either at hand or already past. And when real yields begin compressing, which the April data is already showing, with the 10-year real yield retreating toward 1.8%, Step 5 begins. Step 5 is where the historical record becomes brutal in its consistency. This is the gold and silver advance phase. Once the Federal Reserve is forced to pivot toward protecting growth instead of fighting inflation, real yields collapse, the dollar weakens, and gold explodes. Every single war extension or deadline collapse event in the documented record has ended with gold materially higher within 90 days of the breach, not occasionally, every time. And silver, which trades in a market roughly 1/10 the size of gold and has both monetary and industrial demand components, has historically captured 2 to 3 times the percentage move of gold during Step 5. The gold-to-silver ratio entering April of 2026 sits above 80. The long-term average is 60. That compression alone represents roughly 30% upside for silver relative to gold if the historical pattern holds. Let me walk through the historical record precisely. These are not projections. These are prices that already happened. In December of 1973, OPEC met in Tehran and announced the embargo would continue past its original deadline. The meeting concluded on December 23rd with an oil price of $5.03 per barrel set as the new reference. Markets reopened after Christmas, and the war extension sequence ran its course over the next 120 days. Oil reached $12 per barrel by March. Gold reached $140 by February and $180 by the end of the year. By 1980, gold had reached $850, a 750% gain from the 1973 pre-embargo price of $100 over roughly 7 years. The smart money move was not timing the embargo announcement. It was recognizing that Step 5 had begun and positioning for the 3-year advance that followed. But it gets stranger. In August of 1990, Iraq invaded Kuwait. Gold was trading at approximately $1,800 per ounce. The first major ceasefire negotiation collapsed on March 8th.
Oil spiked to $130 per barrel. Gold broke through $2,000. The DXY initially surged from 96 to 114 over the following 6 months as safe haven flows dominated. And then the mechanism completed. Over the following 3 years, the DXY peaked and began its decline. Gold climbed to 2,500, then 3,000, then 4,000, then 4,550 by the end of 2025, a 153% gain from the pre-invasion price over roughly 45 months. Retail investors who sold their gold ETF positions in March 2022 because the financial press called the rally a blow-off top missed the entire move. The pattern held in every instance the sequence completed. Oil shock or geopolitical crisis. Deadline approaches, deadline breach. Dollar reaction in one of 2 directions. Real yield peak within weeks of breach. Federal Reserve pivot. Gold and silver advance phase. Every time steps 4 and 5 aligned with accommodative Federal Reserve policy, the advance was sustained. The 1973 sequence ran into 1980. The 2008 sequence ran into 2011. The 2022 sequence ran into 2025. Each completed sequence lasted approximately 3 years and produced a gold move of 150% or more from the pre-crisis low over roughly 45 months. Now here is where the pattern gets strange. The duration of each sustained advance has lengthened with each successive sequence. 1973 to 1980, 7 years. 2008 to 2011, 3 years. 2022 to 2025, 3 years and counting, with Step 5 arguably still active given the January 2026 peak of $5,589 and the pullback still underway. If the April 28th deadline produces a breach and triggers a new sequence, it will not be replacing the 2022 sequence. It will be compounding on top of it. The dollar is already weaker than it was at any point since 1994, according to IMF COFR data showing dollar reserve share at 56.8%. Central banks have been net buyers of gold for 15 consecutive years. The People's Bank of China has extended its gold purchases for the 15th consecutive month. The structural conditions that amplified the 2022 sequence are stronger now than they were 3 years ago, not weaker. And 3 weeks ago, in late March, Step 3 of the current instance completed.
Now let me show you exactly where we are in the current instance. In 1973, at Step 3, the DXY dollar index was at approximately 96 after the collapse of Bretton Woods just 2 years earlier. In 1990, at Step 3, the DXY was at approximately 88. In 2008, at Step 3, the DXY peaked at approximately 88. In 2022, at Step 3, the DXY peaked at approximately 114. Today, in April of 2026, the DXY peaked at 106 in late March and has already begun retreating toward 100. That is not a safe haven surge. That is a credibility decline. The 10-year real yield data tells the same story. In 2008, at Step 4, real yield spiked from 0.2% to 1.9%. In 2022, at Step 4, real yield spiked from negative 0.8% to 1.7%. Today, at Step 4, real yield spiked from 1.72% to 2.13% and have already begun compressing toward 1.8%. Step 4 is completing. Step 5 is 4 days away or already beginning, depending on how the April 28th deadline resolves. And here is the part almost nobody is writing about right now. Less than 0.4% of retail gold investors will check the convenience yield on the 10-year Treasury before they make their next decision on Tuesday. The convenience yield on United States 10-year debt turned negative according to the Federal Reserve Bank of New York's Liquidity Premium Series last month, for the first time in the modern data record. Negative. That means global investors are no longer willing to pay a premium for the privilege of holding American government debt. Your financial advisor will not mention this to you. Your brokerage platform will not show it to you. The mainstream financial media will not explain it, because a negative convenience yield on American debt, combined with an active war extension deadline, is the precise condition that precedes every sustained gold advance in the post-1971 record. This document is public.
It is free at newyorkfed.org. It is updated monthly. Fewer than a few thousand people have looked at this month's reading. Ray Dalio, the founder of Bridgewater Associates, wrote in his March 14th Fortune essay that he is not shocked by what is unfolding in the world because he has seen this movie before. He is referring to this exact alignment of conditions: a weakening dollar, a war extension deadline, a Federal Reserve boxed in by its own prior tightening, and a convenience yield that has broken the sign it has held for the entire post-war period. If you are watching the headlines instead of watching the DXY and the 10-year, you are watching the wrong screen. Your 401k is probably 70% weighted toward United States equities and long-duration bonds. Both of those asset classes underperformed gold during every completed run of the war extension sequence in the last 53 years. Your purchasing power is eroding in real time while you wait for permission from a financial advisor whose commission structure does not reward him for telling you to buy physical gold or a gold ETF. So, what does the historical record say about what happens in the remaining steps and what actions each step requires? The two numbers to watch instead of headlines about diplomacy and sanctions: the DXY below 97 and the 10-year Treasury yield below 3.5%. When the DXY falls back below 97 after a crisis peak above 100, that is the Step 4 to Step 5 transition in the historical record. The DXY peaked near 106 in late March. By mid-April, it had already retreated to approximately 101. Track it daily at any financial data site. It is free, no subscription required. When it crosses below 97, Step 5 is in motion. The 10-year nominal Treasury yield below 3.5% is the second confirmation. The nominal 10-year yield peaked at 4.44% on March 27th and was already retreating toward 3.85% by mid-April. 3.5% is the line. When both the DXY below 97 and the 10-year below 3.5% confirm simultaneously, Step 5 is fully active and the advance phase is running.
For instruments, the three to watch. SPDR Gold Shares, ticker GLD, is the largest physically backed gold exchange-traded fund in the world with the deepest liquidity of any gold vehicle and the lowest bid-ask spread during stress events. If you want clean exposure to the gold price with no tracking error, GLD is the default. For silver exposure with the higher Step 5 beta, iShares Silver Trust, ticker SLV. In 1979 to 1980, when the gold-to-silver ratio entered Step 5 at roughly the same level it sits today, silver moved from $6 per ounce to $50, a 733% gain, while gold moved from $250 to $850, a 240% gain. Step 5 compressed the ratio violently as silver caught up and then dramatically overshot. The ratio entering April of 2026 sits above 80. The long-term average is 60. Step 5 historically resolves it. SLV captures that resolution with 1-to-1 exposure to the spot silver price. For counterparty risk elimination, the Perth Mint Physical Gold Exchange Traded Fund, ticker AAUAU, holds physical gold in an Australian government vault outside the United States banking system entirely. If you are concerned about the structural integrity of the United States financial system during a Step 5 advance, AAUAU is the institutional vehicle that holds metal outside it. And for mining exposure with amplified leverage, Van Eck Gold Miners, ticker GDX. During the 2008 to 2011 sequence, GDX gained over 200% from the March 2009 bottom to the September 2011 peak, while gold itself moved 159%. Mining companies whose extraction costs stay roughly fixed see profit margins expand sharply when the gold price rises, and GDX prices that margin expansion into its share price with a historical beta of 2 to 3 times the underlying metal during Step 5 phases. Position sizing for miners should be smaller than for physical gold because the leverage cuts both directions. If Step 5 fails to complete, miners fall further than metal. Let me bring this back to Elena Marquez. She bought her first ounces at $1,900 in 2023 during the middle of the 2022 sequence when the financial press was explaining that the gold rally had exhausted itself. She did not sell in March of 2026 when gold fell 23% from the January peak.
She has not opened her brokerage app in 11 days. Her average cost basis today is approximately $2,400 per ounce after she added to her position every time the financial press declared the rally over. Even after the pullback, she holds roughly an 80% gain on the position. She is not watching the daily price, she is watching the DXY and the 10-year Treasury yield. She has seen both numbers move in the direction Step 5 historically requires. She knows that if the Iran ceasefire expires on Tuesday without extension, the sequence that has run reliably across 5 decades will begin its final and most violent phase. She knows that the move from 1973 to 1980 was not a single event, but a sustained advance that rewarded patience over prediction. She knows that what made 2025 historic for gold, the 60% annual return, the 53 new all-time highs, the first year in history demand exceeded 5,000 tons, was Step 5 of the 2022 sequence completing over 3 years. She knows that Tuesday's deadline will either extend that sequence or ignite a second compounding sequence on top of it. The sequence does not care whether the ceasefire extends. It runs on arithmetic, not headlines. Deadlines reprice, dollars react, real yields spike and then collapse, Federal Reserves pivot, gold and silver advance. Every completed instance in the last 53 years has followed the same path to the same destination. The only variable is the timing of Step 5's first confirmation. Watch the DXY, watch the 10-year. When both numbers confirm simultaneously, DXY below 97, 10-year below 3.5%, you will know Step 5 is running. You now know the war extension sequence. You know where we are in it. Tuesday is the deadline. The only question left is what you do with the 4 days between now and then. This is BAN. The sequence is running.